The median household income in the United States is currently frozen at $83,150, yet the math required to own a home in a Tier 1 city has effectively decoupled from reality. Even if you and your partner both earn the median wage, totaling over $166,000 a year, purchasing a median-priced home in San Jose, San Francisco, or Los Angeles is now a mathematical impossibility without a massive, multi-six-figure cash down payment. To bypass this barrier, desperate buyers are flooding the market for duplexes and fourplexes, but this move into multi-unit properties comes with a violent price premium that single-family data doesn't even begin to capture. When you transition from a $1.3 million home to a $1.8 million duplex in the Bay Area, your debt service doesn't just increase, it aggressively outpaces the rental yield of the second unit. You are forced to inject your own W-2 income just to cover the monthly deficit, pushing your personal debt-to-income ratio to the absolute limits of federal regulatory thresholds. The wealth gap has reached a breaking point, with the typical homeowner now earning 85% more than the typical renter, leaving you with a chilling choice: subsidize a massive monthly loss through house hacking or be permanently locked out of the coastal economy. This isn't an investment strategy anymore. It's a mandatory prerequisite for survival that is leading millions straight into a cap rate collapse that makes positive cash flow a statistical myth. The most jarring reality of the 2026 housing market is that it is now mathematically impossible for a highly leveraged retail investor to see a single cent of profit in high-cost cities. Between 2020 and 2022, you could lock in a sub-3% interest rate and use rapidly appreciating rents to cash flow from day one, but that world is dead. Today, the exact same property that once carried itself requires massive, ongoing out-of-pocket capital injections just to keep the lights on. Gross rental yields in San Francisco and Los Angeles have collapsed to an abysmal 2 to 3%, which looks like a financial suicide mission when compared to the national average of 6.5%. Institutional capital has flooded the market with $165 billion in volume, seeking safe harbors and compressing cap rates to levels that utterly destroy your ability to use leverage. While commercial multifamily cap rates in San Francisco average 5.87%, the small 2 to 4 unit properties you are looking at are yielding a dismal 2 to 4%. When your cap rate is lower than the 6.10% mortgage rate, you have guaranteed negative leverage, which is a fancy way of saying you are paying the bank for the privilege of owning a liability. Let's look at the brutal arithmetic. A $1.5 million duplex in San Francisco with a 2.5% cap rate generates just $37,500 in net operating income. If you use an FHA loan with 3.5% down, your annual debt service, just principal and interest, hits $105,000. That is an immediate negative cash flow deficit of over $67,000 a year, or $5,645 every single month. This monthly deficit completely nukes the live for free narrative pushed by side hustle influencers, proving that you aren't an investor, you're a tenant subsidizing your own mortgage with a second job. Professional investors are fleeing these markets in droves, leaving behind desperate first-time buyers who are about to hit a capital expenditure nightmare that no spreadsheet can prepare them for. If you can't afford an existing duplex, the common hack is to build an accessory dwelling unit, but the cost to physically manifest these units has surged to prohibitive levels. In the San Francisco Bay Area, ADU construction now commands between $450 and $600 per square foot. Building a standard 800 square foot ADU in Los Angeles requires up to $400,000 in liquid capital, and that's before you hit the $60,000 wall of city permitting fees and utility trenching. When you amortize the debt on that construction loan at today's rates, the payment often equals the rent the unit produces, rendering your entire 2-year construction headache economically inert. Even if you don't build, the cost to maintain aging coastal properties has decoupled from historical norms, with the repair cost index soaring to its highest level since 2009. Replacing a standard HVAC system in 2026 now breaches the $20,000 threshold in high labor markets. The old rule of thumb to save 1% of the home's value for repairs is dead. On a $1.3 million property, that's $13,000, but modern data shows the average homeowner is now paying over $24,000 a year in non-mortgage costs. 85% of American homeowners faced an unplanned repair last year, and 70% of those went over budget, creating a financial distress trap that insurance companies are making even worse. Insurance premiums are now rising 8.7% faster than the national inflation rate, accounting for nearly 10% of your total monthly mortgage payment. In states like Georgia and Colorado, premiums have spiked by over 25% in a single year due to convective storms and wildfire risks. Carriers are abandoning California and Florida entirely, forcing you into the excess and surplus market where rates are unregulated and coverage is stripped to the bone. By late 2025, these high-risk policies accounted for 16% of all new insurance, an explosive increase that signals a looming equity wipeout. In the most exposed regions, rising insurance costs have already wiped out $44,000 in home equity per property, placing low down payment house hackers underwater before they even find a tenant. While the insurance crisis bleeds you dry, municipal governments are tightening the vice with predatory taxation to fill the holes left by empty commercial office buildings. In Los Angeles, special assessments and voter-approved bonds have pushed effective tax rates toward 1.45%, creating a $13,000 annual burden on a median home. Measure ULA has choked off multifamily liquidity, while San Francisco's assessment roll has ballooned to $353 billion, ensuring your holding costs rise every single year regardless of your income. New York City is no better, where the mansion tax now hits standard 3-bedroom homes in Brooklyn because the $1 million threshold hasn't been adjusted for inflation in 35 years. This creates a tax cliff where properties between $1 million and $1.05 million disappear, as sellers are forced to slash prices to avoid a $10,000 tax hit for the buyer. New legislative proposals like the Mamdani package in 2026 are looking to add even more surcharges, targeting real estate as a primary revenue vehicle for the city. Every marginal dollar you manage to squeeze out of a tenant is being preemptively confiscated by the city, but that's only if the law even allows you to rent the unit at all. The ultimate death knell for the urban house hacker is the total eradication of short-term rental yields and the expansion of aggressive rent control. New York City's Local Law 18 decimated the Airbnb market, reducing inventory by 95% overnight and destroying the supplemental income that thousands of owners relied on to pay their mortgages. Ironically, citywide rents still surged by 8% after the ban, proving that the law didn't help affordability, it only pushed mom-and-pop owners closer to default. In San Francisco, the rent ordinance has capped annual increases at a microscopic 1.6%, which is a mathematical death sentence when your insurance and repairs are climbing at 20%. Landlords are responding by removing 15% of the rental housing supply entirely, converting units to condos or selling to wealthy owners just to escape the compounding deficit. Even state-level attempts like California's SB 9 have failed, with only a few hundred applications for lot splits across 13 cities because the middle class simply doesn't have the $600,000 in cash required to build. The zoning might have changed, but the math hasn't, and lending institutions have noticed, slamming the door shut on anyone who isn't already wealthy. Banks no longer accept creative projections for house hacking. They now enforce the strict FHA 75% rule, discounting a quarter of your rental income before they even consider your application. If your W-2 income can't service the entire $6,000 a month mortgage on its own, your loan is denied, period. This underwriting wall has triggered an avalanche of defaults among those who managed to get in with low down payment loans at the top of the cycle. FHA delinquency rates have skyrocketed to 11.52%, the highest level of distress seen since the pandemic shock. Retail house hackers had zero financial cushion to absorb a $3,000 tax reassessment or an insurance spike, and now the banks are moving in to seize the assets. Completed foreclosures are up 59% year over year, with Texas, California, and Florida leading the nation in raw bank repossessions. The popular narrative blames Wall Street hedge funds for this crisis, but the empirical data proves that mom-and-pop investors are the ones actually outbidding you. Institutional investors own less than 3% of the single-family rental stock, and they are actively retreating from the market as their purchases fell 65% from their peak. The competition in Seattle or Brooklyn isn't Blackstone, it's a wealthy W-2 professional looking for a place to park cash, making political bans on corporate buying a useless piece of theater. Generation Z and millennials are the ones being pushed into this macroeconomic meat grinder, with over half of them viewing rental income as a mandatory requirement for buying a home. They are leveraging themselves to the absolute limit just to qualify for a mortgage on an asset with a 2% yield and a $20,000 annual repair bill. This demographic desperation is exactly what's fueling the record delinquency rates, as the younger generation substitutes extreme financial leverage for the wage growth they never received. The era of effortless equity capture is over, and the brutal math of 2026 now punishes speculation with swift and absolute liquidation. The house hacking dream has turned into a capital preservation nightmare, but while the coastal markets are imploding, a massive migration of wealth is quietly shifting to the yield havens of the American South. If you want to see the specific cities where cash flow is actually still possible and how to spot a yield trap before it destroys your net worth, you need to watch our breakdown on the Great Sunbelt Migration.